It's Kit Trades, and today I'm going to take you through every large major red flag news event that majorly affects the Forex and stock markets. That way you know exactly what all of them are, you know all of the jargon, and you can stay ahead of the game, okay? I'm going to go over a few economic indicators that there's announcements and meetings on that greatly affect the market, days that you shouldn't trade because of high volatility. Okay, these indicators include the Consumer Price Index, CPI, Core Personal Consumption Expenditures, PCE, the Federal Open Market Committee meetings, which is FOMC meetings, the unemployment rate, the non-farm employment change, and the federal funds rate. All right, so we're going to start with the CPI. CPI is the Consumer Price Index. That's one that actually was announced today if you're watching this video. So the CPI is simple, all right? It measures the change in prices of goods and services consumed by households, right? So when CPI rises, it indicates inflation, and when CPI decreases, it indicates lower inflation or reduced inflation, all right? So to break it down simply, the CPI just measures what an apple cost yesterday or last year to what an apple cost today. It's just measuring the difference in the price of goods from this year to last year or 10 years ago or whatever, all right? The Core Personal Consumption Expenditures Price Index, right, the PCE Price Index, is similar to CPI, but is considered a more accurate measure of inflation by the Federal Reserve. It measures the change in prices of goods and services consumed by households, but it excludes volatile items such as food and energies. So basically the CPI is just breaking down the different costs between anything in the market, and it's kind of saying, look, things are more expensive now than before. But the PCE is like a little bit more detailed. It's saying this is the difference of prices between like main important non-volatile things. So it's generally a little bit lower and a more realistic indicator of inflation versus the CPI might be a little bit more loose, all right? The next most important thing is the FOMC meeting, all right? That's the Federal Open Market Committee, all right? The FOMC is the body responsible for setting monetary policy in the United States. The FOMC meets regularly to discuss economic conditions and make decisions on interest rates, okay? That's the key there, interest rates. So the FOMC has meetings on interest rates. If interest rates go up, that means borrowing money is more expensive and generally stocks will go down. And if FOMC decreases interest rates, that means money is cheap to borrow, which means everyone can kind of grow their businesses and generally stock prices will inflate, okay? The next one is the employment rate or the unemployment rate. The unemployment rate obviously measures the percentage of labor force that is unemployed but actively seeking employment. When unemployment rate is low, it can indicate a strong economy and probably an increase in stock prices. But when the unemployment rate is high, it can indicate a weak economy, which can lead to a decrease in stock prices. All right. The next important indicator is the non-farm employment change. Non-farm employment change measures the change in the number of people employed in the U.S. economy, excluding farm workers. Right. So non-farm unemployment change is positive if it goes up, obviously, and it can indicate a strong economy where a lot of people have jobs. Obviously that can lead to increasing prices on NAS 100, US 30, and stocks in general. Conversely, when non-farm unemployment change is negative, it can indicate a weak economy, which obviously can lead to decreasing prices in certain indices and stocks. The final red news that we're going to cover today is federal funds rate. All right. The federal funds rate is the interest rate at which banks borrow money from each other overnight. So it's essentially saying how much it costs for JP Chase Morgan to borrow some money from Wells Fargo. Okay. It is set by the Federal Reserve and is used as a benchmark for other interest rates. Right. So obviously, if that's a lower rate for the bank to borrow money, then people can borrow money from the bank for less because they borrowed the money for less. All right. When the federal funds rate is high, it can indicate a strong economy and lead to an increase in stock price. And when the federal funds rate is low, it can indicate a weak economy, which can lead to a decrease in stock price. All right. So in conclusion, there have been some key economic factors that can have a significant impact on the stock market. Keep in mind, however, that the stock market is affected by a variety of factors, and impact of a specific indicator can be varying depending on the current economic and market conditions. Additionally, it is always recommended to keep an eye on the news and trends in the market. So essentially TLDR here is that you don't want to trade on red days, red news days, which are all the days that we just talked about, because essentially those days can cause large movements, high volatility, gapping, and slippage. So if you're you know what I'm saying, if everyone's selling or buying at the same time, it can cause huge candles, which for the most part, you don't want to be on the wrong side of. So it's best just to sit out. All right. My name's Kit Trades. Thank you guys for watching so much. I hope that I answered all of your red news questions. You know, I feel like I left out a few red newses that seem less important to me and a few yellow newses. Maybe I'll cover those in a part 2. But yeah, thanks for watching, and you know, go watch my other videos to check out some free strategies like the aardvark and the boom slaying that'll get you profitable in Forex ASAP.